Welcome everyone. Today we are going to discuss a very specialized yet extremely important accounting standard, Ind AS 104, insurance contracts. Unlike other Ind AS, this standard deals with business where uncertainty, risk, and long-term obligation are at the core of the financial reporting. Insurance accounting is not about recognizing the insurance value, but about understanding the risk transfer, expected future cash flow, and policyholders' obligation. Ind AS 104 is an interim standard which allows insurer to continue with their existing accounting practices, but with strict safeguard to ensure transparency, adequacy of liabilities, and proper disclosures. To understand this standard clearly, we need to focus not just on definitions, but on the logic behind recognition, measurement, and special concepts like shadow accounting that apply uniquely to insurance company. In today's session, we will cover the following agenda. We are going to touch base and understand the objective and scope. We look at the definition of the insurance contract. We'll understand the concept of recognition principle and measurement principle with respect to Ind AS 104. We'll look at the key measurement test, which is the liability adequacy test and the impairment test, concept of shadow accounting. We'll talk about the disclosures and comparison with the IFRS 4. So let's start the discussion and move to the first slide, which is objective and scope. Okay, now we'll come to the first slide, which is the slide for objective and the scope. So objective. So this standard Ind AS 104 applies to insurer, which means the entity that issues the insurance contract. And it also applies to insurer for the reinsurance contract that are being held. So typically two scenarios are covered here, insurance contract and the reinsurance contract held by the insurer. Main important point here that we need to understand is it is a temporary standard until full IFRS 17 is adopted. So as of now, IFRS 17 has not been adopted. So once that is adopted, this Ind AS will become redundant and would be overtaken by IFRS 17, in which case it is Ind AS 117. So we look at the scope then. So scope is it applies to the insurance contract issued, reinsurance contracts held, and financial instrument with discretionary participation feature. So what does this mean? So which means that any kind of the insurance contract which has a participation clause attached to it, which is like a particular kind of bonus that would be payable upon the maturity of the policy, guaranteed, which is like guaranteed sum assured, which is it can be additional bonus, and then bonus declaration would be at the discretion of the insurer. So whenever these elements are there in a contract, it is called a financial instrument with discretionary participation features, and that contract includes a discretionary feature, which means that the amount is payable at the discretion of the issuer, in this case it is the insurer. It excludes the investment contract without the insurance risk, warranty contracts which are covered under Ind AS 37, and the employee benefit plans which are covered under Ind AS 90. So the objective and scope clearly determines the key features under this Ind AS 104. So it is specifically applies to insurer, the entity that issues the insurance contract, which has the element of significant risk attached to it. And then what is that significance risk? What is the concept of insurance contract? We're going to cover that in the upcoming slides. So let's move to the next slide then. Okay, so key element of insurance contract, what exactly insurance contract is. So a contract under which the insurers accept the significant insurance risk from the policyholder by agreeing to compensate the policyholder if specified uncertain future event adversely affect them. So which means that the insurer agrees to compensate the insured for the risk for which the insured is paying the premium to the insurer. And that risk is significant insurance risk. This makes this insurance contract different from the normal financial contracts. So when we talk about the policyholder, so policyholder is the insured party. Insurer is the entity which is accepting the risk or issuing the contract note. Insurance risk is the uncertain event which is causing a loss, and compensation is the payment or benefit on the occurrences. So these are like significant key elements of the insurance contract: policyholder, insurer, insurance risk, and the compensation. Now, the most important point that we have to understand with respect to insurance contract is the element of significant insurance risk. So insurance risk is considered significant when the insurer accepts significant insurance risk, meaning the insurer could be required to pay substantially more if the insured event occurs compared to it if it does not. So which means that if we typically take an example of any medical insurance or any motor insurance or any kind of accidental insurance in which the amount that needs to be compensated when that risk arises is multiple times, or let's say many times more than the amount which has been paid by the insured to the insurer in the form of premium. So that is the element of the significant risk. So we have shown it through an example here. So life insurance is like policy paying 10 lakh on the death, general insurance, motor insurance covering accident loss, health insurance, policy reimbursing the medical expenses, and reinsurance contracts, insurer transferring the risk to the another insurer. So in all these cases, the risk is much more than the amount that has been paid by the insured as a premium to the insurer. And this risk arises on the happening of the event, which is being death in the case of life insurance, in the case of general insurance, depending upon the accident which is being caused damage to the vehicle, health insurance, any medical expenses, the cost of treatment and the medical expenses that needs to be borne by the insurance company, and then reinsurance contract whenever any contract is reinsured by the insurer with the another insurance company. So this clearly articulates the concept of insurance contract and what is the definition of significant insurance risk. So we'll move to the next slide then. Okay, now we'll talk about the recognition principle, which is the core for any Ind AS accounting. So for insurance company, the insurer recognize the insurance contract and the reinsurance contracts as an asset or liability when the party enters into a contract. And for insurance liability, recognized when the policy is issued. For reinsurance, assets are recognized when the reinsurance contract is acquired. So what we have done, we have created a small table to demonstrate the triggering event. So for insurance contract issued, the triggering event is the issuance of the policy. We have to recognize the insurance liability. For reinsurance contract held on acquisition of the reinsurance asset, we have to recognize that particular asset. Which means that for recognition of reinsurance asset, this is the accounting entry, which is the reinsurance asset to payable or the bank. But for insurance contracts, wherein we are assuming the liability, the treatment is a bit different if it is an endowment plan versus if it is a term plan. And in a term plan, which is like a plan wherein the risk is assumed for annual basis, and if that event does not happen in that particular year, the entire amount is treated as a income. So for term plan, whatever premium we have received, insurance company has received, it is transferred to unearned premium liability, which is transferred to the premium income at the end of each accounting year. But for the endowment plan, whatever amount has been received, it is issued as insurance liability, and it is transferred to the claim payable on the happening of the event or once the policy is getting matured. Because this is the liability, the amount that we have received is going to settle the claim either at the maturity or on the happening of a event basis which the liability, which claim is getting paid to the insured. So this is the recognition principle for insurance as per Ind AS 104. Now we'll move to the next slide to understand the measurement principles. Okay, now we'll talk about the measurement principle for Ind AS 104. An insurer shall measure the insurance contract liability uses existing accounting policy. So this is most important, subject to the certain condition. Ind AS 104 is interim standard. So it allows the insurers to continue with their current actuarial and the gap-based measurement method. So which means that this standard still follows the old methodology of the gap-based measurement method until and unless Ind AS 117 is finally implemented. So as of now, the Ind AS 117 has not been finally notified by IRDA, and hence the insurance company is still using the Ind AS 104 for measurement principle and for their presentation and disclosures, and they are following the principles that was there in the gap-based measurement method. So insurer must ensure that so even though it is being measured at the gap-based method, the most important point that needs to be taken care of is insurer must ensure that liabilities are adequate, which means that the liability should not be less than the expected claim that needs to be settled. No excessive or hidden reserves are created, and reinsurance assets are tested for the impairment. So this conservative approach needs to be adopted while doing the measurement. So component, if it is insurance liability, measurement approach is the actuarial estimate of the expected future flows. This is the approach which is basis which that particular liability would be measured. If it is the reinsurance contract, it will be measured the fair value or the recoverable value, deferred acquisition costs as per the insurance policy, and then the financial instrument with the specific discretionary rights to it. This is treated like the insurance contract. So the objective of this slide is to demonstrate how the measurement is happening basis the gap principles, and this is interim till the time the final Ind AS 117 is being notified by IRDA. So we have to measure the insurance liability basis the actual estimates for expected. This is the expected future cash flows for reinsurance asset fair value, deferred acquisition costs is as per the insurance policy, and then financial instrument with the discretionary profits rights is like treated with the insurance contract. We'll talk about two specific principles on the measurement, which is like liability adequacy test, and then second one is the reinsurance asset, which is tested for the impairment. So these are the two tests which are mandatory for the insurance company to test. So we are going to discuss that in the next slide. So we'll move to the next slide then. Okay, now we'll talk about the two specific tests that needs to be done with respect to the insurance company. While first one is specific to the insurance company, which is liability adequacy test. Second one, which is the impairment of reinsurance asset, is largely the impairment testing that needs to be done and aligned with the Ind AS 36. We'll talk about the liability adequacy test, which is that each reporting date, insurer must test whether the recognized insurance liability is sufficient to meet the expected future claim, and if there's a shortfall, it has to be recognized in the P&L. But for impairment for the reinsurance asset, it is aligned with the Ind AS 36. So whenever there are triggers that exist, then we have to do that impairment testing, and then we have to pass the necessary impairment entries. This is that impairment testing output. Under Ind AS 104, insurance contract liabilities are measured using the existing accounting policies, subject to the adequacy and the impairment test to ensure the liability and the transparency. Again, the measurement principles will definitely have a different conceptual understanding when we compare it with Ind AS 117. But till that time it is being notified, we are going to adopt the same gap principle of measurement, which was demonstrated in the last slide, and we'll continue to do that until it has been finally notified by IRDA, and then it is become mandatory for the insurance company to adopt Ind AS 117, and on which date Ind AS 104 would become redundant. So we'll move to the next slide. Okay, now we'll talk about the important concept that is unique to insurance company, which is the shadow accounting. And what does this mean? So shadow accounting is basically a kind of a methodology which allows an insurance to adjust related insurance liability or deferred cost when unrealized gain or loss or assets are recognized directly into the equity instead of P&L. So this is optional, but it applies if applied, it needs to be applied consistently. This is eliminated in Ind AS 117 because in that asset and liabilities are directly built in. So, but till the time it is one Ind AS 104, we have to understand the concept of shadow accounting. So, insurance company often have an asset wherein the investments measure the fair value. We have the insurance liability, which is linked to the returns on those assets, and then policyholder bonuses like DPF dependent on the asset performance. So typically, when we have a kind of a situation wherein we have to give an amount which is linked to the outcome of the assets, then it has a direct impact on the payout to that particular insured or set of the insured, which is being directly linked to the performance of the asset. So if asset gains go to the OCI but liabilities stay unchanged, so which means that profits become distorted, equity does not reflect the true obligation of the policyholder. So which means that whenever the outcome of the asset or the value of increase in the asset is attributable to the insured because they have taken a plan, this is which the performance or the performance of the asset is being attributable to the insured in the form of the bonus. So in that case, the amount which is attributable to the OCI is also a portion which is attributable to the insured person because he has the equal right. This is the kind of the plan that he has taken. So which means that shadow accounting fixes this mismatch primarily for the participating insurance contract with discretionary participation feature and deferred acquisition cost if linked to the asset performance. So whenever the plan is linked with the asset performance, then insurer cannot account for the entire gain in their OCI, considering that they have the increase in the fair value and the entire gain is the OCI gain. That is not the right scenario because it will reflect the increase in the equity, which is actually not the equity because portion of it is something that is payable to the insured and that needs to be accounted as a liability. So we have demonstrated this through an example here. So if let's say insurer holds an investment which is the fair value through OCI. Unrealized gain recognized in OCI is 100. Policyholders entitled to 90% of the investment return, which means that out of that 100, 90 is attributable to my policyholder or the insured people. So if let's say my investment in FCOCI is there and I will credit my equity which is the OCI, that is the wrong accounting here because my investment in OCI definitely got increased but my equity is not got increased by 100 because out of this 100, 90% is going to go to my insured people because they are linked with the outcome of the asset policies. So overstates the insurance equity if it is not a shadow accounting. So with shadow accounting, what is happening? We are transferring the 90% of the amount which resides in the equity to the insurance liability because this is an amount which is payable to my insured people who have bought the policy which is having the discretionary participation feature or it is linked to the asset performance. So this is the concept of shadow accounting is important because it eliminates the risk and make sure that we have adequate liability and also it also clearly shows the transparent and the fair view of the accounting affairs of the insurance company. So this is the concept of the shadow accounting which is unique to the insurance company. So we'll move to the next slide then. Okay, now we'll talk about the key disclosures which needs to be made as per the requirement of Ind AS 104. So accounting policy for the insurance contract, recognized asset liability income and expenses, assumption used in liability adequacy test. This is very, very important, and risk management and the sensitivity analysis. All these are the mandatory disclosures that are required to be done as a part of Ind AS 104. So with this, we'll come to the last slide then. We'll move to the last slide, which is comparison between the Ind AS 104 vis-a-vis IFRS 4. Okay, now we'll quickly talk about the comparatives between the Ind AS 104 and IFRS 4. So largely they are fully converged and there is no difference as such. The only thought is that because this is an interim or temporary solution, because the full-fledged Ind AS 117 is still not been implemented in context to the Indian scenario because it is not being finally notified by IRDA. So with this, we come to the end of this session, we'll move to the final slide, which is the thank you slide. Okay, so this is the final thank you slide for Ind AS 104. So the key takeaways from this session is that Ind AS 104 is not about recognizing insured values, but about recognizing risk, obligations, and adequacy of liabilities. This conceptual clarity is essential for both exam success and the real-world insurance accounting. Thank you for your time and attention. If you found this session useful, do share it with your peers and let me know in the comments which Ind AS you would like to explore next. However, as per part of our normal Ind AS series, we are going to come up with Ind AS 105 in the next session. And definitely the sequential logic of Ind AS 104 is Ind AS 117. We are going to cover that in the sequential order in the coming days. Thank you and have a nice day.